They are some very interesting points. One is that you're seeing kind of this weaker employment growth, at least from the Fed's view, which is interesting going into next year because markets are very, very bullish about economic growth next year. They're expecting another very big surge in earnings for the S&P 500, and particularly even in small caps and mid caps, they're expecting a 59% increase in earnings next year. But that's derived from economic growth, yet the employment data is suggesting that the economy is slowing down. The inflation data also kind of suggests the same thing. And one important point that you bring up, and I just want to make sure that this doesn't get overlooked by our listeners, is that there's been a lot of conversation this year about when Trump first announced tariffs, like, oh my gosh, this is going to send inflation to the moon. The Fed's going to have to start hiking rates. And what we've now find out is that tariffs really haven't been that big of an inflationary impact because producers are having to absorb a lot of that cost because they can't pass it on to consumers who are showing some signs of weakness. But most importantly, the point you made is that tariffs are a one-time impact. And this is really important for our listeners to understand, is that if I have a product that I sell for $1 and I put a 10-cent tariff on it, so it's now $1.10. Yes, there's an inflationary surge this year on that product. But if the product is still selling next year at $1.10, including the tariff, the inflation rate on that product is 0. These tariffs are a one-time impact on consumer goods. But if the price remains the same through next year, there is no inflation from that tariff. As long as we don't keep hiking tariffs every year, that tariff impact goes away.
That's exactly right. That's the standard economist interpretation of tariffs, and that's what the Fed will look at it as well. Now, the consumers, they'll give you another story because they care about the price level, and that's totally legitimate. But the central bank, though, and since they're kind of, from market standpoint, how they think is going to be very important, that's how they look at it. You got to look through it. Yep. Now, you raised a very, very important point. We're expecting a lot of good earnings and so forth next year, and yet the labor market doesn't seem to be doing well. Now, that's another very interesting thing in the Fed's forecast. They actually notably upgraded their GDP forecast next year, even though they left their unemployment rate forecast still relatively elevated. And what that tells me is that they think that we're maybe undergoing a productivity boom where we can use the same amount of people and produce more goods and services. Otherwise, you would expect in order to get more growth, we'd have to have more people working, right? More labor. But from their forecast, though, if they're holding the labor market unchanged and upgrading GDP growth, they're thinking that we might really be in a productivity boom. And that could be good for growth, could be good for corporate profits as well. So that's an interesting thing in their perspective.
Watch the full interview by clicking on the link below.